Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Ms. Schneider, Director of Trading Education at MarketGauge.com to discuss cyclicals and if they can hold up in a rising interest rate environment. Mish, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. It's great to be here.
And as you know, interest rate yields are all the rage right now as short-term yields rise, and how this relates to inflation. That's really the conversation in the marketplace. And Mish, my question to you is, the data the Fed relies on to guide their decisions shows inflation is under control, but I'm having a hard time understanding that because the experience has been very different at the pump or when you go grocery shopping. So what's happening there?
Well, they use something called the personal consumption expenditure. And even though gas prices are a part of it, it really has a lot to do with how much consumers are buying in terms of real travel, clothes, essentials, and those, of course, have been down since the pandemic. So they're basing their inflation metric on that, and they're not looking at food, and they're not looking at energy, two prices that have really gone up. Now, yes, the gas pumps could eventually work their way into an inflationary number, but it's really just been a bounce off the lows. It's not like oil prices have gone ballistic at this point. So that narrative could change if it does. But right now, Powell spoke this morning, and this is what he talked about. Inflation's under control. We'll let it go to 2%. It's nowhere near there. And he's just very singularly focused on the recovery part of the consumer spending.
And how is the US dollar making an impact?
Well, what's so interesting right now is, and I've done a lot of research on this, the dollar relationship to the market, the dollar relationship to rates. And what I have researched was that there really isn't any hard and fast relationship, and that's exactly what we're seeing right now. The dollar is weak. It's really basically hanging on for dear life here at a very critical support area. And so if the dollar continues to break with yields rising, what it does is it sort of supports the inflation narrative. Obviously, if our dollar buys less, that's inflationary. But at the same time, with the yields rising, some of that inflation fear might get somewhat mitigated, but I don't think that that's necessarily what's going to happen. If the dollar goes into some kind of free fall, that would be a reason for concern on many levels, actually.
So the question is, can cyclicals hold up? I mean, they have the most sensitivity to rates, right?
Not as much as the big tech. And I know the last time that you and I've talked, I mentioned that big tech was not where I would put my money, not in the Microsofts and the Apples and the Amazons, that I thought that money was dead. Of course, I could have never had the foresight to know that the rates would go up, and that would also put the kibosh on them. But the question of cyclicals is interesting, because if everything goes down, then obviously nothing really holds up that well. And especially if we're starting to see interest rates going up too. But Powell said something very different today. He said that he's going to continue to be accommodative, and he wants to see a full labor market before he does anything different. That's where the cyclicals are reacting to. They're reacting to the fact that the economy is hopeful to reopen, that Powell is going to be accommodative until that actually happens, and that in terms of the industrials, the manufacturing, the retail, the transportation, all of that right now is still relatively outperforming, even with the correction we've seen in the last couple of days. And I think transportation is particularly interesting to watch right now because of the infrastructure package that's also circling around the Capitol building right now to see if we can ever get to any kind of bipartisan agreement. But right now, infrastructure is really important.
So I guess the question is, every time that they hint, even if it's a year or two from now, taking rates up 0.25%, the market's gonna have a tantrum, sell off 20% like it did at the end of 2018. I mean, it's unrealistic that this, once the economic recovery takes place, you can't just be in a low interest rate environment forever.
Well, if you remember what happened in 2018, when
Right.
They just suggested that the
Sold
rates
off
could go up.
20%.
Right, exactly. We had that big pop, and then as soon as you went, no, 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 never mind. Well, that's a really good point, because people are looking at some kind of a bubble, but bubbles could go on for 10 years before they burst.
Mm-hmm.
So we don't really know what's going to happen ultimately. The modern monetary theory is that you can have as much debt as possible. As long as the country doesn't go under, it doesn't matter. And that's really what the Fed has been sort of not officially following, but that seems to be the policy. So I think what the Fed is hoping is that if the recovery gets robust enough and people are back working and money is going into the system, that that they can kind of then start inching up the rates. But until they see that firmly no, would the market react to that? Well, hopefully it would be just the normal parameters of any correction. You know, we can handle a 5 to 10% correction off of highs. We don't want to see a 20% or greater collapse because he's doing it too soon. I don't envy his job at all. It's tough.
I was thinking the same thing when I was watching the testimony earlier. And I feel like the Fed has become so politicized when it historically or should not be as politicized. So I agree with you, Mish. That is definitely one position that I do not envy. As always, thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.